Thank you for coming here. As you know, we have a panel assembled for you to unpack the issues related to investments as related to China. We were having a pre-discussion earlier. These are such big words, right? China is everything. Investment can cover everything. So we're hoping to narrow down on a couple of the most relevant issues, both short-term and long-term. And with that, I'm very honored to introduce our panel here. And I think we have a very diversified panel here with Richard as a China researcher for WorldQuant, two top China bankers, Wei and Jin from Morgan Stanley and JP Morgan, respectively. And Wei Jian is temporarily missing, but he's going to join us in a minute. I think the process of miking him up took a little bit longer. Wei Jian runs PhD Capital, as you know, in the private equity space. I was at Penny on the real estate. So there are two experts in the private market side as well. I'm Kevin Liu. I run Partners Group's business in Asia out of Singapore. And Partners Group is a private equity fund. We run about 70 billion assets of private assets. And we have 260 people in Singapore. And this is our second largest office globally. And Wei Jian, please come to your seat. And very good. Very good. So let me maybe start with a couple of comments. The reason I mentioned at the very beginning, this is a very broad topic, is that if you look at China's economic development, right, I think the role of capital, particularly of foreign capital, has played a very important role. So FDI, for many years, was very, very important. I used to work for the World Bank, so we started engaging with Chinese government in the late 70s, early 80s, when there was practically very little of foreign capital. So that importance of FDI, as well as the non-financial aspect coming with foreign capital in terms of management skills, mindset, has always been very important. But you can argue that has changed a little bit the last few years. The role of FDI, the importance of FDI in the Chinese economy has changed a little bit. You see that a little bit from how the government looks at this, right? It's hard to blame them, right? You have high savings rates, a lot of domestic capital in China looking for areas to be deployed. And so I think that's one bucket of issue. It's about FDI into China, what's happening, what has happened. The second area, which is equally, if not more interesting, is outbound. Again, I think as Chinese economy grow, as both personal sort of capital accumulation, corporate capital accumulation, or just sovereign capital accumulation continue to grow, it's inevitable, as you have seen the last few years, you see Chinese capital going into many parts of the world, right? So my firm is headquartered in Europe, so we have a lot of conversations with, for example, German-speaking Europe, and you'll be surprised at how far-reach that effort has been for the Chinese entities, both commercial and government linked, to be exploring the area where they can buy a company and where they can put their capital into use, both to grow as well as to acquire technology and other areas. So there are many, many aspects of this. Why don't we start from Richard? Maybe, Richard, you come from a more research background, so maybe if you could share with us a little bit how you look at, in general, Chinese economics, the role of capital, that'd be great. Richard.
Sure, thank you. Thank you. I like to take a look from the 10,000 foot. At a macro level, from a long-term perspective of China's economy. And Adam Smith said in its Wealth of Nations that in order for a country to have a prolonged and sustained growth, it actually needs to go through a few stages of developments. In each stage, there's set industry that will go through their proverbial S-shape of growth cycle. And when you have multiple stages of growth, then you can have decades and maybe even centuries long of growth and prosperity. And the stages often go through from manufacturing, low to medium tech, to higher value-adding engineering professional services, and then into investment and financial engineering. And this is the experience of some of the successful economies in the world. For example, Singapore, or UK, or the US. Now, if we take the same three stages of development to look at China, I think we can all agree that China, over the last 30 years, have achieved a remarkable success in the first stage of manufacturing industry. As far as the second stage is concerned, the higher value-adding engineering and professional services, I think China has put in the right building blocks that one can foresee that for the next few decades, it should do well in the second stage of its development as well. And what are some of those building blocks? Well, for one thing, over the last 20, 30 years, the Chinese government has widely broadened the higher educational opportunity to its citizens with a strong emphasis in engineering and science. The fact is, over the last 20 years, if you look at the IMO, which is International Mathematics Olympia competition, China is usually ranked #1 in the world and sometimes #2. So with this base of highly trained, well-developed talents in engineering and science, on one hand, and on the other hand, I think China has also put forth a set of macro-industrial policies that are helpful for the development of the second stage of its industries. For example, the Made in China 2025 plan is a set of plans that encourage and support and incentivize the development of certain targeted industries, including, for example, advanced information technology, AI and robotics, biomedical engineering. And all these are exactly the second stage of the growth industries. So I think combining a broadening out of highly educated, well-educated engineers and scientists, plus supportive government policy, one can foretell or foresee that over the next couple of decades, China should continue to achieve a growth path in the second stage development of higher value engineering and professional services. Now, let's talk about the third stage, which is the investment and financial engineering, financial industries. Well, I think it's reasonable to say that relatively, China is still in the early stage of this S-curve. But I do believe that China has put in some good foundations that can enable it to grow well in decades to come in that industries. And what are some of the foundations? Well, first of all, over the last 20 years, China has accumulated a sizable investable assets. By some estimates, it's over $8 trillion. And also, over the last, partially because the availability of the investable assets, it has led a part of the Chinese society to, and including some of the brightest and smartest people, to shift into financial industry or with a goal of developing a career in financial industry. About 10 years ago, if you look at the best and brightest students in Chinese National College entrance exam or their IMO gold medalists, you'll find that they all choose to study either engineering or science, typically electrical engineering, computer science, mathematics, physics, and automation in Tsinghua and Beida. But if you look at the same today, you'll find the brightest and smartest of the Chinese college students, more than half of them choose to study economics and finance. And combined with the growth of investable capital, plus the growth of intellectual capital within the people, I think one can foresee that there's a good, reasonable chance that China, in the decades to come, will grow well in the final stage of financial investment and financial engineering industries. And I think what this means is for the next decades or so, we can see that there will be a fasten of pace of China's financial market developments, and we'll also see a gradual opening up, which we've already seen some of those actions in place, gradually opening up of the China market. And I think that will represent a very interesting opportunity for international investors in risk diversification and in good returns.
Thank you, Richard, for that. So let's take that 10,000 feet view maybe down to deals and practicalities. I'll come to our two top bankers, maybe Wei first. You have been in the business for 30 years, advising Western clients, including doing acquisitions in China. What do you see recently in the FDI space? What's new in terms of the capital that you are advising that's going to China? Then I'll come to Jin. Right.
As we look at FDI, I think the post-2012, the volume of business have really slowed down. And well, there is a growth, but the growth has slowed down and to a certain extent plateaued. I think, Kevin, you mentioned a couple of reasons. With abundant liquidity in China, low cost of funding, and also the valuation of good targets are getting high. And in addition, there are abundant domestic PE firms and the VC funds bridging the funding needs between investors and also the companies, especially private guys that, as we know, the capital market has not been that active. And so the capital market actually was not the best forum for the private guys to really get access and raise funding. So the domestic competition is another major reason. And I think in addition, as we know, there was an issue of exit. CSRC has recently been very focused on taking care of its very long backlog, the pipelines for IPOs with hundreds of companies. I mean, as they are very focused on this, hopefully in the next year or year and a half, they will clear this long pipeline that will make the exit more available, then it will become more encouraging for the foreign players to come into play. Then there is another important aspect of it. Just talk about us, Morgan Stanley. We're financial institutions. We have been doing business in China for 23 years. And we're very committed to China. We have joint ventures in various kinds of aspects of a business, but the ownership has been capped. Right now, at the current level of 49%. So I think it is a very big focus of the industry globally, and also I think it is also the focus of Chinese security regulators and the leaders to really open up this ownership kind of barrier, because it's really important for the foreign institutions to be able to have a control of the business you have in China. So that will definitely bring in more capital and more best industry practice and help to improve the governance of various kinds of players in the market. There is also another reason which I wanted to mention in specific, and that is the opportunity to acquire control interest, whether it is in private or SOE sectors. For private guys, as we know, they build their business, work really hard, and naturally, they did not want to sell it to, especially control stake, to outsiders. And so hence, the minority stake in a even fast-growing and fantastically run company is not as attractive for a lot of investors. For SOEs, even though the SOE reforms have been going on for a long time. There are a couple of examples of spinning off some subsidiaries and at the subsidiary levels to introduce various kinds of private ownership. There is the intent to actually even track the foreign ownership. But the reality is, at the deal level, is difficult. First of all, when foreign investors come in, very few people will use straight cash. You will do structured deals. And that kind of sophisticated deal transactions, maybe it's a little bit too early for China. And secondly, for overall investors coming into these SOE sectors, people are worried. Do I really have control as a shareholder? Because there have been complaints that despite the, I got in as a shareholder at a subsidiary level, but the decisions are largely made still as a group by the parent company and the big SOE board. So I think these are the potential opportunities. And these are also, I want to mention, related to this, transformational changes, which I think is on the horizon that we need to focus. I think, first of all, for the private folks, how long have they been building their empires? A lot of them have become flagship of the industries, but through 20 or 30 years of hard work, these people are no longer young. So there is an issue of succession. Naturally, they will pass on to their younger generations, their children. But as you know, nowadays, the younger generations do not necessarily share the same inspiration or interests. So therefore, there will be situations that there will be a change of control that taken place in the private sector. And for the SOEs, the party congress will take place on October 18th. Will be, in my view, a very important inflection point, because post that Congress, there will be a lot of focus coming from the state-owned enterprises from SARSEC to truly transform itself and kick off the SOE reforms. For example, you already saw transactions like CNBM and Sinomar doing big mergers. But consolidation is not just the name of the game. The most important thing we need to pay attention on the post-consolidation phase, i.e. restructuring. So spin-offs of the non-core business, and also restructuring the subsidiaries that are actually extremely, consist of great assets, but is undervalued. So all of that will create opportunities for potential foreign investors. People may shine away when they hear SOE. Wow, should I get involved in SOE? Of course, we all heard the stories that the cost of the capital is very high and the return capital is half of that. But the reality is that we also have to recognize that SOEs, whether it's central or provincial, they do hold the best assets of China. So therefore, if I could offer advice to our investors globally, it is that we are on a leading edge of fundamental changes of a trend. Then this is quite certain. It is definitely worth spending money, time, and energy being on the vanguard of.
Yeah, I think Wei has shared with us a fairly comprehensive list of reasons why the foreign capital has not grown as we saw before. I think 2 points I'm particularly of interest. One is a comment on private side. I think as a private equity investor, I think Wei is absolutely right. We would typically prefer the control situation because we see a premium in that. So last year, my firm invested $12 billion globally. The majority of the private equity investments are controlled majority deals because we believe when you have control, you control your destiny, you're willing to pay a premium, you're willing to handle a higher valuation, right? So I think that's the point later I'll pick up with Wei Jian, maybe on the private equity side. Do you see more controlled deal coming in as Wei has explained, given the succession, given the other reasons. But the second point I want to pick up, I'll come to Jin now, is more the macro regulatory, the sort of synchronization between macro and micro situation, right? I think there's a lot talk this year about China being the new champion of globalization. But actually, when you look at the real reality in the absolute terms, if you compare China with many other developed countries, I think, to be honest, we still see more constraints in terms of what you can do, what you cannot do, right? So Jin, can you comment on that a little bit? Foreign capital go to China, constraints, opportunities.
Sure.
Do you see macro, micro coming together now?
Yeah, happy to. Thank you, Kevin. Good morning, everyone. In some ways, 2017 has been extraordinary. For the first time in many years, we're actually seeing the performance of the macroeconomy and the micro corporate sector in sync. GDP growth in the first half of this year exceeded market expectations at 6.9%. But interestingly enough, if you look at the corporate sector, performance in the past many years was actually very mixed. A lot of companies couldn't make any money. But in the first half of this year, companies are making huge sums of money. Industrial profit growth, nearly 20% this year. If you look at the thousands of companies that just reported earnings in the first half of the year, growth has been very strong. In fact, 80% of the companies we cover have surpassed or met earnings forecast. Even some of the companies which never made money in the past, in the traditional industries, in steel making, in aluminum smelting, they finally turned a profit in the first half of 2017. And of course, in the new economy sectors, from high tech to services to travel to entertainment, companies are literally minting money. So when you think about foreign investors investing in China, they will only invest if they can make money. So now the macro environment is providing them with opportunities which actually didn't exist before. And also what's interesting is that the currency has stabilized. In fact, the Chinese yuan has appreciated 6% against the US dollar in the past 6 months, basically wiping out the depreciation in 2016. China's foreign exchange reserves has stabilized, actually began climbing again since February of 2017. So the macro environment looks more stable than any time in the last several years. And the micro environment, in terms of corporate earnings, actually looks more encouraging than any time in the last 5 to 6 years. So what is going on here? What has triggered this major change in China's economic performance and corporate performance? So I would say there's a huge amount of government support, liquidity, bank lending for sure. But also, we're seeing for the first time in many years, some of the traditional industries beginning to have pricing power. If you look at the so-called producer price index, which was in negative territory for 5 straight years, now it's positive. Last month, the PPI actually was 6.5%, meaning companies making industrial goods are finally regaining pricing power. So looking at the macro environment, this is actually quite encouraging for foreign companies to put additional capital into China. But secondly, what's interesting is a new announcement by the Chinese government, which some people might have missed. A couple of weeks ago, the central government announced we are going to welcome foreign capital, FDI, again. And this is a departure from recent policies in the recent years. You know, China, we have enough domestic capital of our own. We don't necessarily need foreign capital anymore. But in a departure from recent policy, the recent government policy basically says, we welcome FDI again. In addition, we'll make things easier for foreign enterprises in China. We will reduce a negative list of investments so they can invest in wider areas. We can make profit repatriation easier. We will also extend tax deferrals to foreign companies which invest in the right industries. And this is quite interesting because from a policy a few years ago, we don't want foreign capital anymore, to a policy today, we welcome foreign capital. That's a major change. So as Wei has mentioned, there have been many hurdles to foreign companies investing in China. In fact, since 2015, China's inbound capital has stagnated. Outbound capital has accelerated. In 2016, inbound capital was $126 billion, but outbound capital was $186 billion. So China now sees a need of welcoming foreign capital again, because the capital that comes into China is not just the dollar amounts that matter. It is actually what comes with the money. So I think China also realized the current economic environment has been very hard to obtain, very stable macro environment, stable currency, appreciating currency, increasing foreign reserves. China wants to make hay while the sun shines, right? While the environment is stable, we should state preferable policies for foreign capital. What if 6 months down the road or 9 months down the road, when capital outflows accelerate again? At that point, if you say, well, welcome foreign capital, that may be too late. So I think it's a very astute decision on the part of the central government to announce their change in attitude towards foreign capital at this juncture, when the macro environment is actually very stable. Foreign companies may be more amenable to investing in China. Of course, there are lots of hurdles. There are lots of issues with foreign capital being in China, particularly in the service industry. In the financial sector, as Wei has mentioned, restrictions abound. There's limitations on ownership by foreign companies depending on the types of investments you make, whether it's banking, insurance, securities, futures, and options. There are lots of restrictions. Foreign companies like ours would prefer to have wholly owned entities in China, but right now it's difficult to get those licenses, right? But I would say it's time now to reevaluate China's macro situation, to reevaluate foreign capital's role in China. Of course, during the remainder of this discussion, we'll discuss outbound capital as well. I think the Chinese government does have a sensible dual strategy these days on outbound investments and inbound investments, so they can really corral capital in a much more sensible, much more sustainable way.
I agree, Jean. I think the evolving attitudes by the government towards foreign investment has been very interesting to watch. And I think China is never for the faint-hearted, right? So if you do invest in China, you need to keep track of where that attitude is. And I would also say there's nothing to be alarmed when those changes happen, because I remember a speech by Premier Li Keqiang a couple of years ago when the economic situation was a little bit more problematic. He said, running the economy, handling things like this is like playing chess. Sometimes you move forward, sometimes backwards, sometimes left, sometimes right. So I think it's all very normal for those evolution to occur, right? So Wei-Jian, come to you. Private equity, China. Do you see more control deals? Do you see fewer control deals? And you have been a major investor, obviously, in this space, right? Just share with us your insights.
Yes, we have invested a lot of money in China. From my vantage point, by the way, the room is completely dark. I can't see anybody. So I have been staring at the screen and to notice that the title of this panel is China's trade-off. And I was asking the question earlier, trade-off between what? Nobody seems to know. I think when you talk about trade-off, obviously you gain something, you lose something. You have to give up something in order to gain something. If I think about investing in China and think about the trade-off, I think that China is and remains and has been a very, very difficult market. I've been investing in that market for more than 20 years, and I still think that it is probably the most difficult market to invest in to be successful. So it causes a lot of brain damage, and that's the losing side, investing in China. On the other hand, we have made a lot of money in the China market, so that's the gain side. So I suppose there is a trade-off to the extent I'm willing to tolerate some further brain damage. Probably we can gain some more in that particular market.
That's why the LP is paying $220 for.
Exactly. And we hope to do well by them. But PAG is a private equity firm. We currently have about slightly more than $18 billion in capital under management, we have 3 strategies: real estate, absolute return, and private equity. Even though I'm chairman and CEO of the entire group, I focus 100% of my time, maybe 150% of my time, on private equity only. And we have been very active in China market. By the way, we invest throughout Asia, and very often we go out of Asia as well. But China remains the most important market for us in the world. This year, just on private equity, which represents about 1/3 of the capital we manage, manage about $18 billion. On private equity side, it's about $6 billion. We invested no less than $2 billion in China on the private equity side alone, not including debt. This is just equity investment. If you include debt, you double that amount. That is, we put about $4 billion into the China market. And if you look at the deals that we have done, I think it's quite telling. We invested in probably the largest high-end kindergarten business in China called Golden Apple, which is not poisonous. Thinking about Snow White. And we have been very successful running that business. And it's basically a childcare business. The Chinese parents dole out money to provide the best for their children. So it's a very profitable business, and we own 100% of it. It's a controlled deal, and we're very happy about it. We bought out the largest industrial gases company in China, which makes oxygen, nitrogen, hydrogen for industrial users, such as steel mills, semiconductor companies, and so forth. And we bought it out by taking it private from Hong Kong Stock Exchange. And the enterprise value of this company is about $3 billion. The equity is about $1.5 billion. And it's the largest with 30% market share in China. And we own 100% of it. So that company is doing extremely well. We underwrote that its EBITDA would increase by about 6% per year. We did a deal earlier this year in April. So far, it has been running at 40% this year. So that's a very good investment that we have made this year. And third one, we're hoping to sign today, is the largest matchmaking business. And we feel a social responsibility. There are so many unmarried young people, we need to help them. And incidentally, they actually would pay you to help them find the right mates. And we think that this is potentially a very interesting business. We have spent some time looking into this particular sector, and we think that there's a lot of growth potential. We invested with 2 foreign strategics into China, or bring their products into China this year. One is called Food Union, which is a fairly sizable dairy product company in Europe, producing high-end yogurt, ice cream, and so forth. They wanted to get into China, but they had very little knowledge of this market. So we invested with them to help them set up their business in China, and that is going very well. And it's actually a greenfield product, even though we invested in a mature company. But greenfield project in China, building 2 plants, which will come online next year, early next year. And the next one is a largest consumer finance company in China, owned by foreign shareholders. And this company accounts for about 50% of all the profits in consumer finance sector last year. So that's how large it is. And we have become a strategic investor because we need to help them grow their business in China, in view of the fact that many of us at PAG are very familiar with Chinese financial institutions and have invested in the financial institution sector for a long time in the past 2 decades. So we see many opportunities in China, even though each one of them is quite difficult, challenging. And if I look at what has changed in the past, say, 10 years in China market, I would think that historically, when I was managing TPG Asia or Newbridge Capital, we very much focused on SOE reforms, taking SOEs private. And we thought that particular theme was very attractive and created a lot of potential and upside for ourselves. So 5 years ago, I was very hopeful that there would be more SOE reforms. We typically are very reluctant to get into a joint venture with SOE. So if we buy, we would buy control of a company. So that involves some measure of privatization, which we have done successfully in the past. So far, we have not seen much movement in SOE reform. And therefore, even though we have taken private some business in the past 5 years, but the amount is relatively very small. What we see interesting is the private sector, which has become much bigger and much more scalable. 10 years ago, it would be hard put to put $100 million into a deal in China. And today, you can easily put a couple of $1 billion into a transaction, especially if you're talking about controlled transactions. And most of those opportunities come from the private sector. And that's where we focus our effort and resources.
Thank you, Wei-Jian, for this. Congratulations on the deals that you're working on. I think I just echo that the whole state-owned enterprise reform, also known as hybrid economy, is clearly in the long run, I think, an important space for us to watch. But in the near term, there hasn't been a large number of assets you can really approach. But on the private side, we certainly, for my firm, Partners Group as well, we certainly have seen more opportunities. In the recent years, we have invested in a baby products retailer in Shanghai. We have invested in fast food Chinese, sort of Chinese food fast chain. These are interesting assets that are completely on the private side. Nothing to do with the government. These are just private entrepreneurs who happen to be willing to share the business with a value add for an investor. And so let me turn to real estate side, Kenny. And how do you see the China market? You guys have invested quite a bit, and we have invested together in a few things in China. Yeah.
Okay, real estate, I would say in terms of real estate industry, foreign investment is actually not a very big part of real estate. Plenty of domestic capital, they're the dominant players. The domestic developers are now amongst the biggest real estate companies in the world. By construction area, by sales volume, they are the biggest already. By market cap, they are, many of them are in the top 10. And this has been a changing landscape. In terms of how the government sees the real estate industry, I think over time, real estate has been one of the 3 or 4 pillars that the government can lean on in terms of controlling or encouraging growth in their GDP. So along with infrastructure, fixed investments, consumption, domestic consumption, real estate, these are like the 4 or 5 major areas where the government lean on for growth. So when the economy goes in a downturn, government relaxes the monetary policy, they roll back a lot of these home purchase restrictions on real estate, and boom, market goes up. Over the years when they have these controls in place, there's pent-up demand being built up, and when they roll these back and stimulate the economy by monetary easing, prices goes up first in tier 1 cities and then especially tier 2, tier 3 cities. When prices goes up too fast, government, because as we know, this government is, the paramount importance is to have social stability. When prices goes up too much, they roll back a lot of these restrictions. Home purchase restrictions, they restrict the amount of mortgage you can borrow, and prices starts to slow down. The growth starts to slow down. And again, it spreads from tier 1, tier 2, tier 3 cities. So from the residential point of view, the best way to actually invest in this is to watch what the government is doing. The best timing to go in is actually when the economy is slowing down, and when you can see signs that the government is relaxing some of these restrictions that they've put on and putting in more monetary policy stimulus. In terms of other areas in real estate which are interesting, I would say there's been a changing landscape. Everyone talks about e-commerce in China. E-commerce is now the biggest sector in China. Biggest e-commerce market in the world is in China already. And it's affecting a lot of traditional bricks and mortar business, real estate-based business. For example, department stores have been going out of business because of e-commerce. How to take advantage of that? Department store going out of business leaves the space, it creates a big empty space. How do you convert these space? So some of the deals that we've done is actually taking empty space, which used to be a department store, and then converting them into useful office space. We did a deal in Beijing a couple of years ago, 3 years ago now, 75,000 square meters, so it's pretty big space, over 5 stories. We're able to turn almost the entire space into office space. 10,000 square meter per floor, 5-6 meter of headroom height, converted them into creative loft-style office space. We ended up leasing that whole space into 7 tenants. So everyone taking on average around 10,000 square meters, very big space. And the inspiration of that came from looking at how tech companies, creative companies use space in other countries, in Europe or in the US. A lot of times they would take old warehouse, abandoned warehouse, with these kind of characteristics, big floor plates, high ceiling heights, and converting them into offices. So we saw an opportunity like that converting department store space. Except in China, this is in the middle of the city, so it's not one single floor warehouse, but stacked over 5 floors. And it has turned out to be a very successful deal. Again, e-commerce may be affecting traditional retail, but it's driving a lot of demand on logistics warehouse. So that's another area that people have been investing in. For ourselves, we have actually raised 2 vehicles to invest in warehouses. The first one was done 2.5 years ago. We raised $300 million just dedicated to logistics warehouse. And from that, we have already built 1 million square meters of space. We've just raised a second vehicle for another $700 million, and that would build another 2 million square meters of space. And it's been leasing very well. We see a lot of demand in this kind of space. Middle class in China is growing. Domestic consumption is growing strongly. Domestic travel is growing strongly. Tourism is growing. And middle class coming up from where in the past they had to save every penny because they don't know how tomorrow is going to be, to now they have surplus spending power. So they start to spend money on not just travel, but also entertainment. So one area of real estate which we found has been interesting and successful for us is luxury outlet malls, so branded outlet malls. So these are malls which we built outside of the main cities, built as European-style shopping villages with shopping, entertainment, eating. So when people travel there, they feel like they're going to Europe. They can take pictures, post it on their Instagram or Facebook, and at the same time do shopping. So it hits the sweet spot on consumption, on entertainment, and on tourism. That has been quite a successful strategy.
Great. I think we have covered a lot of ground in terms of the capital going to China. Let me switch gear a little bit to an equally interesting topic, which is the capital from China, outbound, right? Big topic. You have Chinese companies recent years have been very aggressive in looking at assets, even though recently there have been some guidance from the government that they should be a little bit more selective. You have a sovereign wealth fund, insurance company increasingly interested in allocating assets to overseas. You have a number of other elements here. Private wealth as well, right? In terms of the private wealth from China, interested in overseas. One Belt, One Road is driven by the government in the infrastructure space. Wei, a couple of points on that maybe in terms of outbound?
My favorite topic, because we witness unforeseen explosive growth of outbound activities in 2015. At that time, we thought this must be an anomaly because the volume have reached 100 billion, doubled that of 2014. But little do we know, 2016, double that. So the volume reached 200 billion. And in November, as you know, the government was concerned and started to really announce some sort of like a negative list and saying, we don't encourage people to look into sports, entertainment, movies, and hotels. And also for companies acquiring assets that are larger than their own market cap, we discourage you. For companies who actually don't perform that well, and with very high asset liabilities, limited return, low return on your net asset, we don't encourage you to go out. And for deals exceeding $10 billion, that we are going to really scrutinize. So the volume has come down. Year to date, about 44%, but it still is higher than we thought. Because the first thing we observed is the desire for Chinese companies to go out. It stayed quite, intact. And because there are a lot of them have this strategic demand and abundant capital, even government support, in areas such as green energy, education, of course, technology, and biotech, medical devices. So a lot of very credible buyers. And even though the regulatory process is getting more lengthy, uncertain, there is a certain high execution risk, but deals do get approved. So that's actually an interesting observation. Of course, in addition to the various government regulations, as we know, on 18th of August, government also released a guiding opinion that further clarified what are the areas that are actually prohibited by Chinese company to really buy outside China, and also the restricted areas and also the encouraged areas. That encouraged areas include, obviously, the ones, the One Belt, One Road theme type of acquisitions. And that partly explain, if you look at the destinations of these deals from 15 to today, actually the number one designation is Europe. But it's kind of distorted because you have the Syngenta transaction itself is 40-some billion, and then Ferrari transaction is close to 8 billion. So there are a couple of gigantic deals, but take that away, it's a very similar next to United States, about 89 billion, somewhere over there. But actually in between, it is non-China Asia. Over $120 billion actually spent in Asia, and which actually skipped a lot of our attentions because our radar screens are very much on those high-profile European and US deals. So the One Belt, One Road will continue to drive a lot of transactions, especially in areas China can export capacities in certain industrial sectors. And in addition, and there are also companies that will have reputation, size, and capacity to raise funds outside China. Especially there is no recourse onshore. These kind of transactions are fairly easy to execute because the regulation is a straightforward. Approval process is not onerous. And with that all said, I think what we see here is also some change of behaviors from the buyer, the seller side. The sellers, of course, on the one hand, they demand much higher dual protection mechanism to really address these execution risk and regulatory risks. But they don't shy away from Chinese investors. In fact, we get calls and proactive from potential sellers saying, we like Chinese investors, not just because these guys have cash. And the people know capital is not easy to be now transferred outside, but people understand the growth of the Chinese economy and understand that these Chinese buyers, especially strategic investors, will become the flagship, not only the sector in China, but also in the sector globally. And they want to partner with these Chinese players and they're looking into Chinese certain sectors, especially the new economy. They want to find their future partners for their own growth in the second largest economy. We find that very interesting. Of course, obstacles are also coming from everywhere. In February, Germany, Italy, France have submitted a joint letter to European Commission basically requesting to address the issue of non-EU investors to really actively, aggressively buying premium technology companies in Europe. And in Washington, we know this dialogue has been very open. And today, that the wire that delivered this news, that a Chinese consortium acquisition of a semiconductor company in the United States, Lattice Semiconductor Corporation, was killed. So Mnuchin delivered a message, the order issued by Donald Trump, and this is CFIUS concern. So I think in Washington, the debate is no longer about should we impose more regulation and scrutiny to the Chinese investment, and that has passed. The consensus is already built on that front. The question is, how are we going to do it? So specifically, should the CFIUS be expanded to really address the national interest type of issues or national economic security type of issues? Or should a separate body of procedures be established to address that? So I think that's the reality we're facing. With that all said, in a nutshell, if Chinese buyers are clever and they have the blessing of the Chinese government, which is still there for certain sectors, for certain buyers, and they can get the funding out, and they focus on the sectors that are non-sensitive, but there's still plenty of good assets out there. And so there will be still transactions. So the overexpansion, global ambition, that rationale will stay intact. And as the regulation and also geopolitical tension has eased, I think it is possible we're going to see more pickup of volumes of cross-border MA business.
Great. Jing, can you also comment on Outbound?
Yes. Yeah. I'm happy to do that. On the same day when the Chinese government announced the welcome of FDI into China, they announced the policy of outbound investments. The timing is hardly a coincidence. So in crystal clear language, the central government said, in terms of Chinese outbound investments, there are three categories: encouraged, restricted, and banned. So what are the banned industries? Basically gambling and the so-called adult industries will be banned. Restricted include real estate and entertainment industries, and encouraged basically including companies that are pursuing technology upgrades and also projects associated with the One Belt, One Road program. So the central government now is really scrutinizing some of the companies, especially private companies, which have been using a lot of debt to finance overseas investments. Now, we know debt leverage in China is a major concern. Some of the companies over-leveraged to borrow money to expand overseas. In the recent couple of months, as you might have heard, the central government for the very first time have equated financial risk to national security risk. So they're really clamping down on excessive outflows of capital. In the meantime, they're paying a great deal of attention to financial leverage. Having said that, even though in the first half of this year, outbound investments have slowed from China, we think the desire of Chinese companies, both private and SOEs, to expand overseas continues. I want to highlight a few deals that JP Morgan has been involved in the recent months. The largest transaction from China expanding overseas is basically ChemChina's acquisition of Syngenta. So we were the financial advisor to Syngenta on that transaction, $43 billion US. ChemChina has been one of the most progressive companies in China. 2.5 years ago, we advised ChemChina on its acquisition of Pirelli of Italy. We also recently advised Chinese companies, CITIC Capital, CITIC Limited, and also Carlyle Group on the acquisition of McDonald's, of the Hong Kong China franchise in China. That's worth $2 billion. Also, for the first time, a Shandong company in the textile industry acquired a major European lifestyle brand. And this is actually the largest transaction in that retail lifestyle space. The Chinese company is called Shandong Ruyi. A lot of people don't know about it. It's been relatively low profile, but it's been operating Shandong for a good number of years. So this company acquired the French company, which operates retail stores, Sandro, Mage. You've seen them around in Singapore, in Hong Kong, and elsewhere. So this is, again, a sea change of a textile company in Shandong expanding into the branded retail space. In addition to that, we've been involved with HNA on its acquisition of the 25% strategic stake of Hilton Hotels Worldwide. That deal is worth $6.5 billion, and the stake actually came from Blackstone. So you can see this is just a sampling of transactions we've done in the recent 12 months. And a lot of these transactions are actually in the service industries or in the technology area for a Chinese company to acquire more expertise globally.
Yeah, we only have a few more minutes left, and I was told before the panel, due to some technical reasons, we cannot really do Q&A. It's not because panelists are reluctant to answer questions, but if any of you feel you are confident, you're loud enough that other people can hear, please raise your hand. We'll be happy to try. Basically, the mic doesn't work today here. But while we conclude, you guys think about it. If you have a question, raise your hand. I'll be happy to try. And why don't we give Henny a chance for a question?
Wonderful.
I can repeat your question, yeah, just for the audience.
I would like to ask the panel, maybe starting with you, Wei, what is your interpretation of the Unicom transaction? Does it suggest that the line between privately owned enterprises and state-owned enterprises is becoming blurred? When you see an Ali or a Tencent happily writing a check, some people tell me Outbound will possibly be merged with another insurance company in China. It could be China Life, but people tell me, oh, it also could be Ping An. How do you see this whole trend of private institutions putting capital into state-owned institutions?
So Henny, only one question, 30 seconds for you. We only have 2 minutes.
You make my life very easy. That's a very acute observation. I think it's very true to say the lines are getting blurred. Number one, what does SOE reform mean? Reduction of state ownership. So that means for state ownership that actually now more private capital and ownership will come in. So in terms of ownership, who is 51, who is 49, it's not going to be that clear. Secondly, if you are a leader in a sector, if the state has the national interest and also commercial synergy to really team up with you, that's what's going to happen. That's called the China characteristics, And in a way, you can say that's not bad for China. And most importantly, I think there will be a very good discussion and coordination. The real key is not the strategy, it's execution, whether they can create a successful merger.
When it comes to Unicom, recent attraction of private capital into it, I think in the scheme of things, there's very little significance. In fact, this so-called mixed ownership happened when Zhu Rongji was the prime minister. If you remember, in 2002, 2003, with state-owned bank reform, restructuring, and subsequent IPOs, all of them attracted foreign capital, private capital, to become so-called mixed ownership. I was on the board of China Unicom for many years. I stepped down about 10 years ago. China Unicom, to start out with, is a red chip Hong Kong listed company. So it had foreign capital, private capital, and in terms of governance, I was independent director, and there were a number of people who were very independent, who were independent directors. In terms of compensation, at that time, it was very much market. was changed only since a few years ago when the central government decided to limit the salaries for the heads of SOEs. So when I look at the recent happening, yes, there's a lot of flair about it, and there's a lot of celebration as if this is a very significant step in the direction of SOE reform. I don't think much of it.
Let me just go back. I think we're going to spend the last 1 minute on this. I want each of you to think of one prediction you're going to make in 20 years, okay, in one sentence, highest conviction as related to China and investment. So think about what's one thing you can predict with high probability in 20 years in the long run, right? Only one sentence. I'll start so you can have time to think about it. I actually think the outbound Chinese capital flow will become the most important financial flows compared to anything, right? There are many flows, capital and whatever. I just happen to believe the capital flows from China will be, it won't even take 20 years. I think it'll take a few more years. It will be the most important flow. Maybe very quickly, Wei, anything you want to predict 20 years?
The word that came to my mind is stability. As we live in a crazy world, I think you have a relatively stable, foreseeable, predictable political system and the central power. And that is a huge comfort for all of us doing business in China.
I think China will become will have the biggest middle class in the world, and therefore the biggest consumer class in the world.
Great. Biggest middle class?
Well, China will be a very advanced society in 20 years' time. Even closer to that, by 2020, I think China will be home to a quarter of the top companies globally. So I think investing in China would be a long-term strategic strategy for any investor globally.
Richard?
I think instead of talking about capital flowing, I'd like to talk about human capital flow. I think there's a tremendous opportunity to tap in the well-educated and hardworking people in China. And that's part of our company's success, that we're able to go into China, hire the best raw talent, the IMO Go, the #1 graduate from the best university there, and we spend time and effort, go through a mentorship, develop them.
Okay. Human capital, Wei-Jian?
I'm not a human capital, but I think that what worries me is the economic and trade conflicts between China and the United States, which is going to have an enormous impact on the Chinese economy. What also worries me is North Korea being a thorn on the side of China, and this thing is going to flare up at a certain point, which would cause a lot of economic damage to the country.
Very good. So Wei-Jian has a worry, but others are quite optimistic. Great. That's how I conclude this panel.
I'm a professional warrior.
Of course. Great. Let's thank our panelists for this discussion.